All right, welcome back to day two. In today's video, we will be going about how the market works. So before we learn how to trade, we have to understand what we're trading and how it all works, right? Markets aren't just numbers bouncing up and down on your screen. They're Think about it as something that's living, that it's like a breathing system, right? Think of a marketplace. There's a bunch of people, some are buying, some are selling, and prices are constantly shifting based on who wants what, when, and how urgently. All right? So that's what the financial market is. Whether it's stocks, currencies, futures, crypto, it's all built on five core ideas. You have supply and demand, you have liquidity, you have volatility, you have time, and human behavior. And if you don't understand these basic topics, you're gonna be like someone trying to drive without knowing the rules of the road, right? It's gonna be a mess. You're always gonna be reacting late, you're gonna be confused and probably frustrated. And so today you'll learn about what liquidity and volatility really are, what we are talking about when we mention these two subjects, how different time frames give you different stories, why brokers matters, what is a broker. You're going to learn about the difference between stocks, forex, and futures, and essentially you're going to learn why we're focusing on futures in this specific course. All right, so let's go ahead and jump to the first topic, which is liquidity. So liquidity is the lifeblood of the market. What is liquidity? Liquidity is just simply, it just means how easily you can buy or sell something without affecting its price too much. All right. So imagine this. I made these little drawings here. Sorry, it's not that good. I try my best. All right. But imagine this. Let me pull out the pencil here. Pull out the green pencil. So imagine you're on a busy highway. So this one right here, there's a lot of cars, and this is a liquid market. So you can see you can enter the highway pretty easily. You can exit the highway pretty easily. There's enough room for people that want to remain on the highway to keep going up the highway. And because there are a lot of people buying and selling at the same time. So there's a lot of liquid and there's a lot of movement within the same market. Now, think of a low liquidity market as a narrow highway. You do not want to be on that highway. We all know how it is when you drive. That's an illiquid market. There's less liquid. There's less to no liquid. If you try to pass, if you try to enter the market, you're going to slow everything down. There's a lot of people here that are trying to stay on the markets, a lot of people that are trying to leave, people trying to come in. Everything slows down. You're going to feel the market is very slow and choppy. And so what am I trying to say with all of this is liquidity is really important, all right? The more liquidity a market has, the tighter the spreads are. What are spreads? Spreads is basically the small difference between the buy and the sell price. The more liquidity, the smaller the difference is, meaning it costs you less per trade. All right, we're going to talk about this more in another video, but for now you have to know that liquidity is important because it gives you tighter spreads. So essentially you're buying at the best price. It also allows you to have faster execution. Your trades go through quicker. You can enter the highway quickly and you can exit as quickly as well. All right? There is also what's called slippage. There's less slippage. So you get the price you wanted, not something worse. What often happens when, for example, you're trading on a low liquidity market, you're going to want to, let's say you're talking about gold, you're going to want to buy gold at, let's say, $3,000, and they're actually going to set you in for 3,000. Let's say, I'm exaggerating a little bit, but they're going to give it to you at 3,500. Even though you clicked on $3,000, they're going to give it to you at 3,500. While if you trade on a high liquidity market, yes, it does move faster, but if you clicked for $3,000, at most maybe you're going to get it for $3,001. So this is the reason why liquidity matters. Why what we're talking about when we talk about low slippage. And the other reason why liquidity matters is because it's more reliable for patterns. There are more people, and so the movement of the market is much, much cleaner. All right, I actually write all this. I actually wrote all of this right here. So it's more reliable. There's more reliable patterns. There's more people. The movement is clearer, and it's more. It's overall more predictable, to see in which direction the market is moving. Now, the reason why here I have this little star here near the slippage is because there's another instance. This does not apply all the time for high liquidity markets. We're going to talk about volatility later, and I'm going to explain how volatility can also affect the slippage. All right, so slippage, if I remind you, is the price you buy it for and the price that they give you instead. All right. If there's a high slippage, it's very bad because you're going to buy something at a precise price, and the high slippage is going to give it back to you at a worse price. The lower the slippage, the better it is. All right. So, the S&P 500, which is what I trade, which you're going to see as well, is going to be called NAS, or you're going to see S&P 500. Sometimes you're going to see NAS 100. The S&P 500 um uh futures is one of the most liquid markets on earth, actually, on earth, right? That's why I trade it. It's like stepping into the busiest part of the city. It's like going downtown. You're not going to go shopping in a small village. If you actually like variety, you're going to go downtown where all the sellers are, where all the big stores are at. You're not going to go to a small village where there's no volatility, there's no liquidity, there's no one selling anything interesting. S&P 500 is like that. It's like stepping into the busiest part of the city, and you have so much opportunity. It's like having to choose between working and living in New York, or living on a small secluded island with five a population of 5 people, right? So now let's go ahead and talk about volatility. What are we talking about when we mention volatility? All right. So volatility simply means how much the price of something moves and how fast it moves. So volatility is correlated with opportunity. Why? A calm stock like Apple, within a day, it might go from, let's say, $180 to $182. It's just a $2 change in a day. While the S&P 500 can move 20 points in just 15 minutes. That's the equivalent of $1,000 profit per contract. So we're going to talk about contracts eventually, but you can see that with more volatility, there's movements and prices are much, much bigger, which are essentially giving you much better opportunities and more profits at the end of the day. At the end of the day, right? So why do traders care? So volatility, like I said, means opportunity. The bigger the price moves, the more chance to profit. However, the bigger the price move, the faster you can also lose money, hence risk more. And that's why you'll need rules, discipline, and risk management. And don't worry about it in this course. I'll show you how to ride the waves, now not drown in these waves, right? A lot of people drown in these waves thinking they're gonna make $1 gazillion in a single day, but it's all about risk management. All right, we're gonna go through that in another video, but for now I'm just explaining different topics here. Now, the other thing you must know about are time frames. So time frames are the markets that it's the market that speaks in different speeds. All right, so what is a time frame? Let me go ahead and show you a live market. So I actually have it prepped right here. Let me go on Top Step. This is the platform I use to trade, by the way. So, you can see I already made $1,500 today. Anyways, so if you go over here, you can see there are different time frames at the very top. Let me go and pull out the little arrow here. So if you go here, you can see there are different time frames. There is the 1 minute, 3 minute, 5 minute, 15, 30, 1 hour, 4 hour, daily. These are just the time frames that I use, but there are obviously more time frames here. You can see there's in seconds, there's in minutes, there's in hours. You can select, you can custom it however you like it. And a time frame is how much time each candle that you see, each little bar on this chart, it's basically how much time each candle or bar on a chart represents. So imagine watching the same event going through different lenses. Here, for example, we're on a 5 minute chart. You can see the 5 minute is lit in yellow here. So each candlestick represents 5 minutes. If I go on this one, you can see at the bottom. Let me go ahead and pull this little arrow. You can see here at the bottom, there is a date with a time. So each time I skip one bar, you're gonna see the time go up by 5 minutes. So each candlestick opens and closes every 5 minutes. All right. So if you go to the 1 minute, you're gonna see it's much more precise. It's still going into the same direction, but each bar represents 1 minute. So the 1 minute chart is like watching each heartbeat. If you go to the 1 hour chart, it's like watching the whole day go by. And if you go to, let's say, let me go a little crazy here. If you go to the weekly chart, it's like seeing the big picture over months, right? You can see the months are going by now. Each candlestick represents a week. So, how people use time frames. So, generally speaking, traders use the 1 to 5 minute time frames for precise entries, quick trades, scalping as they call them. This is exactly what I do, right? I use small time frames, the 1 to 5 minute to enter in my positions, which are, called essentially scalping. Now, we use the 15, let's say to 1 hour. 15 to 1 hour is mostly used for intraday structure. If you want to better time your trades, if you want to go ahead and look at the general movement, the general direction a trade is going into. All right. Now, some people use the 4 hour to, let's say, the daily. Each candlestick here represents a day of the week. Here you see it's the 21st. Here we're the 23rd. So basically, it skipped 2 days here because the market's open on the weekend. But the people that use the 4 hour to daily, I still use it as well, just to go ahead and look at the direction of the market. But oftentimes, the traders that only use these time frames are called swing traders and trend spotters. So they're just looking at these frames to see in which direction the market is moving. Obviously, here, if we look at the daily, we can see the market is moving upwards. It's been moving upwards for almost 2 months now, right? So in this course, I'll teach you how to zoom in and out to get a full understanding of where the market is going and where you should act based on the different time frames. All right, so I know it's a lot of information, but don't worry about it. We're going to go all through this information together. All right, so let me just go back here to my notes. Now, let's go over what is a broker. So a broker is basically your access point to the market. What is a broker? A broker is a company that gives you access to the market. You open an account with them and they allow you to place trades through their platform. If I go back here, I'm using here, you can see top left, it says Top Step X. So I am going through this institution called Top Step X, which allows me to trade on the NASDAQ market. And it's like using a bridge to reach the marketplace. Some bridges are solid, some are shaky, and obviously you want to use the strong one, all right? And don't worry about it, we're going to go through all of that eventually. But what you need to know is that there are different types of brokers. There are stock brokers. So these stock brokers, they handle company shares such as Tesla, Apple, Microsoft, Nvidia. And if I could give examples, the brokers for that are like TD, Emirates. There's Robinhood, that's pretty popular. There's Webull. And then there are brokers for Forex. So Forex, for that, they handle currency pairs such as the value of the Canadian dollars compared to the US dollar, or the euros compared to the US dollars. And the most known markets, the most known brokers for that are like Owanda, there's IC Markets, there's Forex.com, and what I use is futures, right? So futures, they handle contracts on indexes such as NASDAQ, S&P, oil. I also have access to gold, and the known brokers, like I said, are Top Step, which is what I'm using. There's TradeStation, there's NinjaTrader. And in this course, we're focusing on futures trading, which means you'll be using either futures brokers or a prop firm like Apex or Top Step or E8 Markets. And we're going to make sure that the broker you're using is, one, regulated. They have transparent fees and offers fast execution. These are very key components that you have to look at before choosing which platform you want to trade on. All right, we're going to talk about that eventually. Now, let's go over stocks versus Forex versus futures. Let's break it down like you're choosing between sports. All right. What's the difference between all of these? Stocks is basically owning a piece of the company. When you buy stock, you own a part of a company. You're investing in their success. Trades happen only during market hours. So New York opens at 9:30 a.m. to 4 p.m. Eastern time, right? They're very regulated and reliable, but you need, I'd say you almost need about $25,000 minimum in the U.S. to quote unquote day trade stocks. All right. So, for example, if you want to trade Apple, Amazon, if you want to see some substantial amount of profits, you would need at least $25,000. Okay. Now, there's Forex. So, Forex is about trading currencies. So, you're buying one currency while selling another. This is what I'm talking about when I mention the US dollar compared to the Canadian dollar. It's open 24 hours a day, 5 days a week. There's no ownership, just a value exchange. So it's really cheap to start, but many brokers are unregulated because of that. Because a lot of people see this as an opportunity to make a lot of money, which they're right about it. If I just show you an example here and go to, let me go ahead and go to TradingView right here. And let me show you a Forex market. So we're going to go, for example, to the USD CAD. So it's the value of the United States dollar compared to the Canadian dollar. So you can see that for us, for me to buy one US dollar, it would cost me $1.37. So I could have, with $1,000, you can see it moves pretty slowly. It moves pretty fast, sorry. But the difference between the values are like, we're talking cents here. But you can still, there's still a high chance, a high profitability that could be, you can make a lot of money through these markets. That's what I'm trying to say. But many brokers are unregulated, which involves a risk because when they're unregulated, sometimes they manipulate the markets. The charts you see aren't really precise. They can deny payouts, take your money, and you really want to make sure that you're choosing the right broker for that. Now, what I trade is called futures. Let me just go back here. What I trade is called futures here. So you can see, if I go back, there's NASDAQ, there's ES, there's, let me see if they have a whole list here. S&P 500, I have Russell 2000, I have oil, I have Dow Jones, gold, copper, silver. And with futures, it's basically contracts on assets. I'm not owning the asset. I'm just trading a contract based on its price. So I can trade oil, gold, S&P 500. I can trade corn. I can literally trade corn. All right. The value of corn. This is amazing. You guys want to trade corn? All right. So this runs almost 24/7. Actually, when it runs 23/5 to be exact. It closes over the weekend, and it's very liquid and transparent. There's very to little there's almost no rules when it comes to trading on this market. You can trade freely, and it has built-in leverage. So small money can control big positions, essentially, which is just the beauty of it all. So the reason why this program focuses on futures is because of transparency. Futures, when you trade on futures, the trades go directly through real exchanges. There's no funny business. All right. There's no, you don't need to spend $25,000 you don't need to have $25,000 to trade. You can start small. You know, there's a structure, there's patterns that repeat often, especially during New York hours, 9:30 to 4 p.m. There's leverage, so you can trade large positions with smaller capital. The markets are very consistent. So ES, S&P, Nasdaq, they move very cleanly every single day. You know, it's clear movement to, let's say, the downside or upside. There's, it's amazing. So I personally trade Nasdaq because it's liquid. There's a lot of liquidity. It's structured. Sorry. There's it offers clean and repeated setups. And if you stay disciplined, this market will reward you. All right. So, without making this video too long, I want to talk about what God says about all of this. Now, it says in 1 Corinthians 14:33 that for God is not a God of confusion, but peace. So when you look at the different markets, it can seem like there's a lot of noise and chaos and the movements are weird. But if you pause, if you breathe, and if you learn to observe, you'll see order, you'll see patterns, and you'll see timing. The same God who designed the tides, the stars, the seasons, and also created the world, he also helped create these markets that move with a certain rhythm. So you're not here to control it. Keep that in mind. You're not here to control the market. You're here to understand it. A lot of people try to trade trying to control the market. They have a certain expectation on as to what the market should give them, how much they should make in a day. You're not here to control it. You just follow the tide. You are here to understand how it moves. All right? So, little assignment for the next day, day 3. What I want you to do is go ahead and open a live chart so you can go on TradingView, the platform over here. And what I want you to do is, just for fun, guys, it takes like 5 minutes. I want you to go ahead and open S&P 500 or Nasdaq. Open Nasdaq. Let me go ahead and go to Nasdaq. I want you to go ahead and open Nasdaq. And what I want you to do from here is from 9:30 a.m. to 10:30 a.m. Matter of fact, let's do it from 9:30 a.m. to 10 a.m. I want you to see how the market moves. Oh, it's asking me to create an account. I don't have time for that. So I want you to go ahead and see how the market moves. What do you see? Are the movement fast? Are there certain pauses? What do you see? And I want you to compare the 1 minute. So here, if you go to the top, you're going to see it's where it says a D. You can select different time frames. So I have 1 minute, 3 minute, 5 minute. You can put some stars on it so you don't have to continuously just click on it. There you go. I'm putting stars over here. So what I want you to do is I want you to compare the 1 minute time frame. Oh, I'm on 3 minutes. The 1 minute time frame with the 15-minute time frame with the 1 hour time frame. And how does each chart tell a different story? I want you to understand that. At last, I want you to go on YouTube if you have time. You don't have to do it right now because I'll talk about it eventually again. But I want you to go on YouTube or on any, on your browser and look up your broker or prop firm you want to use. So what fees do they charge? Are they regulated? Do they have certain rules that you have to respect? Do they give you access to real exchanges? How do they work? You have to look that up. All right. So I'll see you guys tomorrow. And tomorrow we are going to go over something quite interesting and important as well. By the way, guys, let me know if the way that I'm explaining things makes sense for you. If you guys have any questions, of course, I can answer them. You can always ask me questions directly through Discord, which you guys have access to, by the way. It's linked in my description. But tomorrow we are going to talk about the trading terminologies, right? So we're going to talk about ticks. We're going to talk about pips. We're going to talk about lots, leverage, spreads, margin, contracts. What does all that mean? Because I know I've been mentioning it a little bit today. Tomorrow, we are going to go over that and better explain each of these topics. All right? So, it was Purple here and signing off. I'll see you guys tomorrow.